Good day, fellow investors. Obsidian asked me to explain how the market went up 5% in a day, and if I look at it today, it's already almost 2% down. Who knows how it will be by the end of the trading day today. So it's a crazy market, and you probably have seen this already many times, but the market goes up and down depending on short-term supply and demand of securities. That's not that relevant, but what I want to discuss, and perhaps even more important from a long-term investing perspective, are fundamentals that nobody cares given what's going on in the market, and still high valuations that create high volatility. So at the highest point, 5.59 from the intraday bottom to the high, to end the day 2 points up, and after it was down significantly after the CPI report came in. What is the case? It's the largest intraday point swing since early days of the pandemic. So high volatility there, and if we read at what Bloomberg has to say, it is an all or nothing market, and that is the feature of 2022. And the key here, and why I say nobody cares about fundamentals, is that more than 400 companies of the S&P 500 move in the same direction, and that hasn't been seen since 1997, which is crazy, which means that people just look at the market, where the market will go, and not at the fundamentals, because it is crazy that more than 400 saw their shares in red at the beginning of the day, and then at the close 470 were in green. But here I really want to discuss, okay, the market goes up 5%, it goes down 2% then again today, and then who knows on Monday again. It's crazy, but what about the fundamentals? Are stocks really cheap for them to go up 5% in a day on a deserved basis or not? If we look at the fundamentals, if we look at the real P/E ratio of the S&P 500, it is still pretty high, 17 from a historical perspective, and all the other bear cycles in history have seen lower bottoms than the current one. So, okay, it is an interest game reflection on the valuation of the stock market. Of course, lower interest rates create higher valuations, and higher interest rates create lower valuations. We don't know what interest rates will do in the future, but for now, it is still, let's say, relatively expensive historically. But also something very important is look at the swings. If we look at when the largest daily percentage gains have happened, we have 2020, then 2008, October 1987, and then in the 30s. So this is again similarly to the largest daily percentage losses, 2020, 2008, 2001. Okay, one here in 97, but then again October 1987. So whenever there is this bear market crisis, 2008, 2020, then you see at the same moment huge positive swings and huge negative swings. So the market gets very, very erratic in these times of uncertainties. So the times are certainly uncertain, but I think that people are completely forgetting about the fundamentals, which is key. Of course, the markets are a voting machine in the short term, but a weighing machine in the long term. How long that long term will be, nobody knows. For now, it's just voting, stocks will go up, blah, blah, blah. But at some point in life, the weighing, the fundamentals must emerge. Because yes, stocks always go up, but what kind of stocks? If we look at the S&P 500 dividend, it's now at 1.74% and up from the 1.2 that was recently as the S&P 500 went down, but we are still far, far away from the historical mean and extremely far away from the maximum. I hope not to see this, but at least from a mean perspective and asking yourself, what am I investing in? This is pretty peculiar, and I still see extremely high valuations, and everyone is taking them for granted because index funds and stocks will always go up. And even if we look at Bloomberg, then it's somebody smartly saying, look at the chart that it's 200-week average, hitting that and then rebounding, and the midpoint of the bull market now. This is just a beautiful chart that tells nothing. So stocks go up and down because of the high uncertainty and because people are now focused on the market and not on fundamentals. A lot of companies might get hit on the fundamentals that we discussed in Druckenmiller's view of earnings and how those are hit. So now, as those earnings come in, it will be very interesting to see whether those will be hit now in Q3 earnings coming up or not. But still, down the road, it's more likely for them to be pressured than what Wall Street expects, which is high upside. Anyway, to conclude, I think that the valuations are high, which means very sensitive to these ups and downs, and everything changes when valuations are high. And then also this mania of always stocks go up and down wherever, let's go into the market instead of real investing, is what creates the current market situation. Will it ever change? I wish I knew. We'll keep on looking at fundamentals, of course, discussing the macro because I know you enjoy it, but we'll focus on the fundamentals, and through the macro, always, my story will always end the same. Let's go bottom up instead of top down. If you like that, smash that like button, subscribe if you haven't, and I'll see you in the next video tomorrow.